since nobody's speaking up. Either you can't hear me or everything is working fine. Thank you. Okay, welcome. And this is the next event in our series of doing what we can to keep our community connected and engaged and continue to provide our community with the education and the inspiration that we all want and need to continue to move forward. And today we're going to there's a presentation that I'm going to give about forecasting and cash management, putting together numbers that investors and customers can rely on and inspire confidence. Before I do, I would like to say thank you to a few people. I don't see one of them on yet, but that's okay. First and foremost is to thank our founding and strategic partner, Maryland Innovation Center, and their representative today, Mr. Doug Holly. Hi, Doug. Welcome.
How you doing there? Good to see you.
Okay, good to see you. And they have been with the chapter since day one, and we continue to grow and evolve our relationship in a lot of very interesting ways. Doug, given that we're now at a point where things are just beginning to open up, is there any news that's fit to print at this point in time?
So we're actually, for the center, we're putting together some guidelines for people to be able to come into the building. Our tenants they are occasionally coming in. I mean, 4 or 5 a day at most. But no official will obviously have to do whatever the state and the county require. And so we are not planning at this point any particular events. We do have the very large conference room downstairs, the new one that we just added. It can seat about 150.
Mm-hmm.
So we figure 30 people in that would probably socially distance properly. So.
Okay. Well, good. That means we can have June's event there in the big, big room.
Right. See, we could be reasonably distanced and hold that event there.
Okay. Well, that's good news. That's something that I didn't know.
Yeah, but I'm not sure they'd let us just yet. But possibly in July or August.
Okay. Fair enough. Thank you. And let's see. There's another gentleman that I would like to introduce. No, he's not on here, so I'm not going to introduce him just yet. So that being said, most of you know, oh, yes, he is. There he is. The other gentleman I would like to introduce is Mr. David Cross. David is the Assistant Executive Director of the Towson University Entrepreneurship Program and their incubator. And David has been a huge supporter of our chapter almost from day one. And I would just like to shout out to Towson and to David. Thank you very much for all your continuing support. Give everybody a hi and give us your 30-second elevator speech.
Well, Towson University Incubator, we are part of the university. We have a small incubator with about 15 offices, but our big news is we're going to be moving into the old Armory building in downtown Towson, for those of you who may know it. So we're going to be starting up a whole new entrepreneurship program focused on student entrepreneurship, community entrepreneurship, moving the incubator in there. We're also going to have some offices in the 401 West Chesapeake building. So there's a lot going on at Towson University around entrepreneurship over the coming years. So keep your eyes out. And thank you, Chris.
Okay, thank you, David. To bring you up to speed, the next item on the agenda is what's coming up in June. We are actually going to be taking a 2-week break. The next 2 weeks, we are not going to be doing our weekly events. We as a team are going to be huddling and putting together what our plan and event activity is going to look like for the balance of the year. And obviously, one of the things that we're going to be weighing is when we get the direction from Doug and from Chuck Bubeck and MIC, we'll then begin to migrate our events to the Maryland Innovation Center. But one of the things that we have decided is that we have gotten a lot of feedback from people that they like the schedule of having 2 events a month. And so what we'll be doing going forward, probably starting in July, is we will be doing 1 event in person, assuming we get into the Maryland Innovation Center. And we'll also be doing a virtual event that will be additive to whatever we cover during our in-person event. The second thing that we're going to be doing is we're going to go to monthly themes, so that instead of just doing 1 event with a theme and doing a shallow dive, we're going to be going into a theme each month that's going to do a much deeper dive. So those are a couple of things that you can expect to see from us going forward. The other thing is that June is our big global Startup Grind Women Leaders in Tech Month. And we've got 2 events coming up that will be the 3rd and the 4th weekends or weeks in June. One of which will be a truly international event where we're going to be partnering with the Brisbane, Australia chapter and doing a joint event between the 2 of us. And the topic is going to be focused about women leaders in artificial intelligence, or AI. And we've got a phenomenal local speaker, Megan Gray, who's going to share her tragedy to triumph story. And our Brisbane chapter is lining up one of the key figures in the AI industry down in Australia and the APAC region. And we're going to hopefully be able to show you guys what the international community looks like. And that'll be coming up the last week in June. We're still working on nailing down the date. So that being said, those are the announcements that I have. And without further ado, I'd like to start the presentation. And bear with me while I share my screen. I would like to say thank you very quickly to come on, why won't it start? Oh, that's why. Can everybody see my screen? Can everybody see my screen? Wave your hand. Okay, all right, good. Thank you. I would like to say thank you to our global partners. I'm not going to read them off. You can see who they are, and as you may well, they're all some very big names in the innovation in the tech space. Even more importantly is I'd like to thank our local partners who, without their help and support, none of this would be possible. So today we're going to talk about cash and financial management and forecasting. And I have been putting this webinar together.
Yes, Emil, this is Jill Johnson. We got a steady work load for my husband, Dave.
Could somebody please mute themselves?
And we're having a lot of trouble with it.
Huh. Okay.
It's Emily Mamary.
What's
You wanna
that?
Mute her. It was Emily Mamary, if you want to mute her.
Yeah, I did. Yeah, I saw that. Thanks, Doug. I do these webinars as part of my business practice, And I did one of these for several other organizations closer to the beginning of March or the middle of March, 1st of April, when for a couple of other organizations, and they said that I needed to share this as far and as wide as possible because it was useful information. So that's what I'm going to do. And it really boils down to successful business, and particularly management of resources, falls into two categories. One is the short term, the other one is long term. And you got to start with the short term. You got to know where you are at any point in time before you can plan on where you want to go. And when we talk about short term, I like to refer to it as less than 9 months. And short-term strategies are all about projecting, managing, and protecting our cash and financial resources for as long as possible to extend our runway. And our runway is defined as being how much money do we have and how long can we make it last, and hopefully make it last long enough until we're able to raise our next round. The primary goals are to stay alive, stay healthy, keep the cash coming in, and most importantly, keep the doors open and begin transitioning from a survival mode into a thriving mode. And then you have the long term, which is beyond 9 months, which is what a lot of people think of forecasting. And it's critically important. But if you can't get to that 9-month level, everything beyond that is kind of meaningless. And what it boils down to is going beyond 9 months and setting the course and direction based on your plans, and then knowing what you need at any point in time, using the short-term forecast as your foundation to project out. And it's going to give you the ability to communicate with confidence and believability, and to convince others, i.e. investors, customers, strategic partners, to buy into your vision. If you don't manage the short term, the long term is going to be a given. Plain and simple. There are a couple of misnomers in forecasting and cash management. The first is that the vast majority of people think that profit equals cash. Well, it doesn't. They are almost diametrically opposed to one another. The clearest example I can give is that you can't spend profit. You can't go and write a check against your net profit at the bank. You can't pay your credit card off of profit. You can spend cash. That's money that you can use to pay your bills. So there needs to be a very clear distinction between those two in the short term and the long term, but it also means you've got to understand the relationship between the two, and that is cash is the resource, profit is the indicator. You can operate a company with no profitability as long as you've got cash flow coming in that is allowing you to cover your expenses. And the two most common ways that we look at forecasting is, one, the P&L statement, which is where you're going to see your profit or loss and where all of your income and expenses are going to be recorded. But then it's also your statement of cash flow or your forecast, which is where you're going to convert those revenue and expense items into sources and uses of cash. So there are a couple of concepts that we need to be aware of. Number one is what's called the burn rate. And burn rate is quite simply your cash out, all of your costs and expenses. But they're on a cash basis, not on an accrual or an accounting basis. Cash flow is your cash in minus your burn rate. And if everything is going well, your cash flow should show green and should show positive, should show growing. But if not, then you've got some things that you need to look at. The way to do it is to develop a short-term cash forecast. And I have found in my years of doing this that the most important thing that anybody can do, regardless of the form that it takes, is being brutally honest with yourself and with your team. And that you can't leave anything out of the forecast. Everything needs to be documented for a number of reasons. The most important of which is if you don't document everything, if you leave something on the table, you've automatically introduced an error and a factor of error into your forecast that's going to impact everything that you want to do going forward. So to calculate the burn rate, we want to take all of our costs and itemize them, no matter how big, no matter how small. And one of the things that a lot of companies like to do is they like to take and include certain personal and family related expenses in the business for obvious tax related reasons. And that's all fine as long as it's legal and your accountant signs off on it. But it's also a potential hole that you need to be thinking about as you build your forecast. The thing you don't want to do is include any non-cash items in your forecast at this point in time. Things like depreciation and amortization. Then what I do is set up a series of spreadsheets in an Excel workbook. And the first one is to identify all of your vendors, suppliers, service providers, and expenses. And again, this is cash out. And the things I like to do is to put in the name of the vendor, the expense category, how much I owe them now, and the priority level. And I'll get to the priority level in just a second. And the when is, when do I think I need to pay them, or when do I expect to pay them? Because that's what you're going to load into your cash forecast. Other things that you want to take into consideration: payroll, one of the biggest expenses all of us have. Well, we have to know exactly what that number is in each and every period so that we have the cash resources to cover it. And what you see there is the annual salary, if they're salaried, if they're an hourly rate, the number of hours that they're projected to work, and the dollars. And this is something that will roll into the cash flow forecast. Then you've got two other categories. One, marketing expenses. And I break out marketing and I break out payroll expenses for a reason, which you'll see in just a few minutes. But the other thing that you need to be thinking about is, what do I owe? Banks, lenders, credit card companies, finance companies, etc. Now, from a profit and loss perspective, those don't necessarily impact your profit and loss statement all the time, but they do impact your cash flow statement, because every month you've got to pay something against those obligations. So knowing that and knowing when you have to pay it is critically important. Then once we get all of this put together and we have these various spreadsheets, I like to go through a process of prioritization. And I classify things in 4 priorities. Priority 1 is those that must be paid. Under no circumstances we can't survive without it. If it's necessary to keep the doors open and operations running, it's got to be paid. So that has to become a high priority. Priority 2 and 3 are still important and critical, but they have some flexibility in them. And so you've got some flexibility as to when those expenses go out. And then the last priority is the one that I focus on first, which is expenses. And we all have done this. God only knows how many times I've done it. We go out, we get subscriptions to software, we we have subscriptions to magazine, we have other expenses that really do not add anything to the short-term bottom line or cash generating resources of the company. And those would be the ones that I would target first to examine as to whether we continue with them or don't continue with them. And the important thing to realize is that in prioritizing these, no two situations and no two companies are alike. So therefore, what I think my priorities are may not be what David Cross and his company thinks the priorities are. So this is not a cookie cutter type of approach. This is where individualization really comes into play and your strategic thinking. A couple things to take into consideration, because one of the things that I have heard, particularly over the last 2 months, is, my biggest expenses. I've got to cut my payroll. I've got to, lay people off. I've got to go through staff reductions. Well, I put forth, and research seems to bear me out, and I think a lot of others, and that is layoffs and staff reductions should probably be the last thing that you look at. If you find that you need to do it, you can also come up with some rather inventive and creative ways of being able to keep people partially employed, but lowering your payroll staff. And one of the big reasons is that companies that do everything that they can to retain their employees during a crisis always seem to come back faster, and the employees are generally far more appreciative and loyal to the company than they were prior to the crisis. And the other thing is that letting go of 1% of your team could have a really damaging effect on the rest of your staff. And that has a multiplicative effect to the operations of the rest of the company. The other thing that I ask everybody to keep in mind seriously, and that is marketing and selling expenses. Yes, they're an expense. And yes, in the immediate term, you may not see an immediate return on those investments. But research has found that companies that decide to prioritize those expenses and do so strategically generally will bounce back and grow 2 to 4 times faster than their competition and be able to take some significant market share away from that competition. So those are two considerations that every owner and every founding team really need to think through before they go and make any final decisions as to what to do with expenses. The second element of it is cash resources. And these are cash resources that you currently have available to you in whatever form that may be. Things like, how much do you have in the bank right now? That is your ground zero starting point. Other things to consider are money that's owed to you that can be converted to cash in 2 weeks or less. Money that customers may owe you and you've given them credit that you may not be able to collect in less than 2 weeks, but you might be able to collect within 4 weeks or 6 weeks. Do you have things like available business loans, lines of credits, company credit cards that you might be able to tap for short-term working capital shortflows if the situation requires it? One thing that I see an awful lot happen, and that is people tend to ignore some things that are on their balance sheet. Things like equipment, inventory, surplus supplies that are owned that, if necessary, may be able to be sold and converted to cash if the need arises. And then cash sources are those that are that can be sold in 45 to 60 or more days. And hopefully you can begin to see here that I've set it up so that we start working with the most immediate sources of cash first, and then work down that trail. And you can consider this a similar prioritization project, similar to the cash uses. And then it's putting together just a very simple spreadsheet, itemizing everything that you have. Here again, the more detail you put into this, the more valuable the information is going to be coming out of it. And so I break things out into cash, credit card customers, things that can be converted into cash immediately or in less than 2 weeks. And then those credit related customers that are going to take a longer period of time. And then you've got a couple of things, and I apologize. I now see that I've got a title up at the top that should not be there. So bear with me. That was a stupid human trick on my part. But again, going back to your banking and your lending relationships, do you have any excess capacity that you might be able to tap if you need it? And then I talked about equipment and assets. It's amazing to me how many companies that I work with have assets that have been fully depreciated off the book. They don't owe any money on them, and are actually assets that are kind of sitting in the corner of the warehouse or in the corner of the office. And everybody kind of looks at them, walks by and said, well, isn't that nice? We'll deal with that at another date and another time. Well, the reality is that's a resource. That's an asset that you could, if necessary and wanted to, sell and get some cash to be able to pay some bills. Now, you won't get 100% on the dollar, but there are resources there that you can use. Another one is old inventory. Let's say you're a retailer and you've got a bunch of stuff that just didn't sell 2 years ago, but you've never gotten rid of it. Well, now may be a time to think seriously about selling it to a wholesaler or a discounter. And even though you may only get 30, 40, 50 cents on the dollar, that's still 50 cents or 30, 40, or 50 cents that you didn't have the day before. So a lot of this takes some work. It's not just something that you can sit down and do in 15 or 20 minutes. It really boils down to some thinking, some prioritization, some planning, and some soul searching. And the end result is ending up with a cash forecast that looks something like this. I like to project out 16 weeks. And I have templates of all of this. So anybody who would like a template or a copy of this workbook, please feel free to put your contact information and your email address in the chat box, and I will send everybody a copy as soon as we finish today. But the cash forecast is really a summarization week by week of all the work that we've just done. It's putting the right numbers in the right buckets at the right time. And we start with cash coming in. What do I have to work with? And then it's prioritizing and listing out cash going out by the level of prioritization that I suggest everybody use. You don't have to use the prioritization method, but it may be good so that you can look at a glance and know what has to happen instead of trying to think through, well, do I prioritize this versus that? You've already made that decision. And then down at the bottom is you take your cash in, you subtract out your cash, you subtract your cash out, and you have what's basically your ending cash balance or your net cash flow. And if that number is a positive, that means that you've got money to be able to live and operate and exist another day. and begin planning for moving forward. If it's a negative number, it certainly indicates that maybe you've got a situation there that you have got to take a much harder and more serious look at. I like to recommend to clients and to the community that this should not be a one-off process or an exercise of doing it once and then putting it on the side of the desk, never for it to see the light of day again. I can't tell you how many clients have done that. And Doug, I think I see a smile on your face that maybe you agree to that with that statement just a little bit. In what I would call a near perfect world, there would be somebody looking at this maybe a couple of times a week. Most companies, until they get to a certain size, don't need to look at it that frequently, but they should get into the habit of doing it regularly. I recommend to start doing it once a week, as part of your normal management process. And that keeps everything in front of you and fresh. You don't have to worry about going back at the last minute in case there's a crisis to figure out where you were and bring it forward. But at the very least, I highly recommend that it become a bi-weekly part of your management team's responsibilities, is to generate this. Because it goes back to, if you don't know where you are and you don't know where you're going, then any road is going to get you there. And so, and the other thing that this does is you sit down in front of a banker, you sit down in front of somebody like Doug or David, who are, are mentors and advisors. These are the kinds of things, these are some of the things that they're going to ask to see almost right up front. Now, does it have to be as pretty and beautiful as maybe I have made this? Maybe not. And it's really not the form so much as it is the substance. But I can pretty well guarantee you that Doug and David and others in similar positions are going to want to talk to you seriously about your short-term cash forecasting, because it's going to affect everything that they do with you as well. The other thing is, you go in front of an investor or an investment committee. There are some things that they look at. One is your team, first and foremost. Are you believable? Do you know what you're talking about? Do you have a handle on all of your numbers? Do you know your burn rate? Do you know your cash flow? If you stumble on any one of those and you don't know that and lock it down, 99% of the time the investor is going to get up and leave the room, because he doesn't have the confidence to listen to you anymore because you haven't done your homework. Now, that can go back and forth between investors. Some are a little more forgiving than others. But the thing that I find consistently is they want to see a long-term forecast and they want to see a short-term cash forecast. And this is one thing that you can do to increase the level of confidence, expand your runway, and build relationships that are honest and trusted with investors and customers. Some things to consider. If you're having cash flow problems, how can we increase and accelerate cash flows? Well, let's start with priorities. What gets the cash in the door the quickest? Stop selling on credit if you're selling on credit. Take credit cards, use ACHs, bank drafts, anything that will get money into your account within 72 hours. You could borrow against your receivables. There are factoring companies out there that will lend money against receivables that are coming due. You can go to your customers and ask them to accelerate payments, possibly ask them for, offer them a discount of X% if they give you cash in a week or less. Also, if you've got long-term contracts that are tied to milestone payments, such as quarterly, semi-annually, or annually, see if you can go back and negotiate discounts off of those for them to be able to pay you on a monthly basis or every couple of weeks. Another thing that can happen pretty quickly is selling your old surplus, unnecessary equipment and excess inventory. Then the other is, are there revenue opportunities that maybe you have not seriously considered, but may be possibilities in the short term? Is there a way you can go to e-commerce for some or all your business? Is there a way you can go out and cross-sell or upsell existing services and possibly increase your revenue from existing customers? Is it possible to increase prices to get you over a certain hurdle if you make certain concessions to your customers down the road, which may be a great way of continuing to build partnerships with customers? And then finally, maybe you can pivot in the relatively short term to develop some low-cost, high-margin kinds of revenue streams that you can implement in 2, 3, 4 months to provide some additional cash revenue. Second thing is to look at decreasing or eliminating anything that you do not have to spend. The first and foremost is shed it. Any expense that does not keep the doors open adds to your ability to generate cash. Maybe you have low profit line items. Yeah, you have some sales, but are they putting cash on, in your checking account? High maintenance, problematic, low profit, difficult customers, vendors, and suppliers. Is it time to take a look at some of those relationships? The other thing is to realize that you have the capability of negotiating everything. That's not necessarily to say that the other side is going to go along with it, but you have the opportunity to approach them to negotiate. Classic example is the banks and lending institutions, and many vendors are helping their customers by deferring or delaying or forbearing certain payments over a period of time to help them get through this crisis. You may be able to go and negotiate something as simple as, instead of net 30, maybe you can get net 45 or net 50 or 60-day terms. Those are things that you can do. And the way I look at it is, look, this is what the big boys do all the time. Okay? Why can't we? Why shouldn't we? Well, guess what? We should. So keep it in the back of your mind. The next item is, you now are in position, now that you have all this foundational information, now you can begin to sit down and examine everything. Maybe you think you have an expense that's a priority that you feel right now is a priority 1 or priority 2. Now you have a foundation to be able to go back and ask yourself, is that really that important to me? Is there another way I could do this less expensively or without paying any money? Look at the productivity of all of the expenses that are absolutely critical. Are you generating as much revenue and as much profit and as much cash out of everything that you do? So is it being as effective as possible? The final thing is to take a serious look inside at your company. Do you have the right performance metrics, the performance benchmarks, the right internal controls in place? Do you have real accountability across all levels of the organization? And when I say that, what I hear a lot is that management teams will say, yes, we're working hard, we're working 14, 16, 18 hours a day, we're eating ramen noodles 7 times a week, we're living off of Monster energy drinks, etc., etc. The question is not how hard you're working. The The question is, are you working effectively, efficiently, and profitably? And is there a way that you could change yourself or your team so that they're not working as much, but the work that they're doing is of higher value? What does that mean? You'll get a greater output per unit of effort than the way in which you're operating now. So all of these really boil down to setting a good foundation for going out and looking at the longer term. Couple of things to remember. Your forecast is only as good as you're using it. If you don't use it, it becomes shelfware. Like I said, plan weekly, bi-weekly at a very minimum. Always consider your survival mode as having at least 6 months of cash on hand or readily available at any point in time. And then with your forecasting, now that you have the foundation, you can begin to build those out years. You can begin to build those out periods. But the thing that you need to remember as you're doing it, because chances are you're going to need outside financing at some point in time, is to think long term, is to think about what your cash needs are going to be in 18, in 24, in 36 months out, and begin planning for that cash infusion at that time instead of worrying about, oh, I only have $5,000 in the bank this month and I got $50,000 worth of expenses next month. I need to go out and raise money. If you take that short-term view, chances are you're not going to be raising much money next month and you're probably going to be shutting your doors. So it really boils down to keeping the proper mindset as a foundation for doing your forecasting going forward. And then finally, it's going to enable you to plan and effectively plan and manage you, your team, your assets, and your resources more effectively and efficiently. And the bottom line is that it's all about building confidence, confidence in yourself, confidence in your team, confidence in everyone around you, that everyone is working effectively and efficiently, because that's going to demonstrate to customers and investors that you've done the homework, you've done the hard work, you've put in the sweat and the energy, etc., to be able to put this information forward. And that just elevates you to the top of the list in terms of the level of confidence that investors and customers are going to have in you, and makes you one of the 5% that goes to the next round, as opposed to one of the 95% that falls by the wayside and you have to go back and start from ground zero. It also gives you opportunities to completely rethink, rework, and retool everything that you do. You know, how many times have we heard it over the last 2.5 months that never let a good crisis go to waste? You know, we've had an opportunity now to have 60 days where we've been able to focus on, or hopefully been able to focus on, some very critical things. Well, now's the time to move beyond playing defense and start thinking offensively, and taking and reworking and putting the thinking and the plans that you've put forth to date into action and making good stuff happen. So, with that being said, that is an abbreviated form of my cash forecasting and management tutorial. I open things up now for Q&A.
Hi, Chris.
Yes.
This is Cheryl Lohman. I'm the CEO and founder of Medaptic, an Internet of Medical Things company. How do you do the forecasting when your product is not yet ready for launch and you're preparing documents such as grants, SBIRs, etc.? That's where the company is right now for us?
That's an excellent question. I'm trying to stop sharing my screen. You truly are a startup, if I'm understanding you correctly, where you have little or no revenue coming in right now, recurring revenue. Am I correct?
Correct. I'm self-financing the company from my own income streams.
Okay.
However, the company is further along than being a startup. However, there are no revenues.
Okay. So there's nothing that you can bank on right now other than the resources that you have available. In other words, you mentioned you're going after some grants and those types of things. But there's nothing else there that you can go out and say, well, I know I've got customer Joe Smith down the street who's going to buy X from me per month. You don't have that yet, right?
No, maybe you can do another one of these startup grinds on how to get those. I'm working on it though.
Well, that's coming. It won't be next month, but it will be the month following. We're going to do a full month on customer acquisition. Right now, it really boils down to you doing a really close examination of your burn rate, which is all your cash expenses.
I've got it right here. I look at accounts every single day.
I'm going to suggest that you don't keep it here. Put it on paper. Put it in a spreadsheet so that you can look at it. I hear too many people say, oh, I've got it all right here. I know exactly what's going on. Fine, but Cheryl, what happens if tomorrow you happen to get hit by a bus, God forbid, and you still have a company that you have to run? If it's up here, it's not doing anybody else any good. So
well, I've got the accounting in QuickBooks. So the idea is to, after this presentation is over, go into QuickBooks and see if there's a worksheet or a report that I can generate from QuickBooks.
There, depending on which version of QuickBooks you have, there is a cash forecast. There's a forecasting system in certain versions of QuickBooks. The problem with QuickBooks is that it's more for budgeting as opposed to cash management.
Got it.
And remember, we're talking. It's more about P&L budgeting than it is forecasting than it is cash flow forecasting, and that's why I'm always very clear with people up front why there's a point at which you have to separate the two. Okay? They will come back together again as your financials begin to grow and evolve. But right now, particularly where you are, you need to be focused on cash.
Right.
Okay. Now, where are you related to some of these grants and other funding opportunities? Can you tell us a little bit more about that?
Sure. Medaptic put in an SBIR phase 1 with the National Science Foundation in December of last year. There were 10 magic words in that grant, basically saying that the product that we are developing called QuickMeds could be used in an epidemic sort of situation. I had no idea COVID was coming. It has been so-called fast-tracked on the COVID, and the program director has come back to me 4 months in a row now asking for adjustments to the grant application so that it would suit their funding. And just today I got another email to supply more information, which of course I did immediately. So that's where that grant stands. That would be for 225, as a phase 1. So then the question is, how long do you hang out and wait on something which is a really awesome opportunity if it happens? but how long can you wait? Summer's here. People are looking for summer opportunities. You can pick up people in the workforce easily, et cetera, et cetera.
Okay. Have you, does your product or your application require government approvals of any kind? FDA, USDA, those types of things where you have to go through a formal review and certification process?
Excellent question. Before COVID, the answer was yes, it had to go through FDA clearance. After COVID, the value proposition changed slightly so that the answer is, at this point, no, it would not require FDA clearance. However, it will need to meet other standards such as UL laboratory, underwriter laboratory and other ISO, validations, so that it doesn't have, for instance, electromagnetic radiation in the hospital setting.
Okay. So even if, as you stand right now, it's not something that you could easily put on the market next week?
Oh, no.
Okay. And I'm also going to refer you, if it's okay, Doug, I hope I'm not stepping on your toes here, by saying I believe if you were to connect with Doug Holly and the people at the Maryland Innovation Center, there may be possibilities and opportunities there in terms of grants, in terms of convertible notes, in terms of access to other resources around the state of which you may not be aware, that may be able to help you to get you to the point where you have received that SBIR. Doug, any thoughts?
Yeah, there are probably a couple of things, and Cheryl and I know each other. I didn't
Oh,
realize.
okay,
Congratulations that they're pursuing you on that. Yeah, we can have a call and see if we can come up with some ideas.
Great. Send me a Zoom invite. I'll make it work.
Okay.
Thanks.
Okay. Any other questions?
So clarification, you say a minimum of 6 months, desirable to have 18 months of cash flow. Now, when I think about that, if I've got a business where I'm purchasing product to make a product that I resell, so there's a COGS, and if I'm not selling it, well, then I'm not incurring that cost. I could look at my cash flow from, if I have, say, I'm spending $40,000 a month paying bills, but half of that is the purchasing cost.
Mm-hmm.
Is your cash flow a suggestion that it's 40 times 18, or is it 20 times 18?
It would be I would call it the net of the two. This is assuming that what you're buying is inventory that you flip, put into COGS, that flips again, that goes into the cost of goods sold and into your revenue. So it would be, again, it's cash in minus cash out. And I didn't explicitly state it here, but COGS and inventory are a critical component of that.
Right.
Particularly, in certain instances. So it would be, in the purest sense of the word, you can think of your cash burn rate as being no income coming in from any source. Okay.
Right. Yep.
All right. With product sales, now you're into net cash flow. So it's cash in minus cash out.
Right.
Yeah.
That makes sense.
Yeah.
Good. Okay.
All right. Anybody else? Well, I thank you very much for attending. I hope that we've been able to provide some value. Again, if you would like, I'll be more than happy to share the presentation and the workbook that I have with you. If you'll just put your name and contact information in the chat box, I'll make sure you get it this week.
Thank you so
Right.
much for having this.
Well, you're more than welcome, and I hope that we'll see everybody back for the next event. And please keep keep an eye out for our newsletters, and visit our website, which is www.startupgrind.com. And one thing I completely forgot to mention, and thank you for that, and that's this. When COVID first began to hit, Startup Grind as a global community went from being an all in-person events organization to being all virtual in less than 6 weeks. Now, what does that mean for us as a local chapter? It means that we now have access to every Startup Grind event being held anywhere in the world. And you can find all of those events out on the Startup Grind global website. I attended one last night from Tel Aviv. I'm attending one tomorrow night that's in London. I'm attending one coming next Monday that's in Sao Paulo, Brazil. And it's wonderful to be able to see what's happening in ecosystems other than what's going on in our region or in the United States. So that is all available out on the global website, www.startupgrind.com. And if there's anything I and the chapter can do for you, please do not hesitate to reach out and ask. So that being said, ladies and gentlemen, thank you very much for your time. And I wish you a great rest of the week and weekend.
Thank you.
Thanks. Nice job. Good job, Chris.